clearly with the deficit increasing, debt to GDP 118%, deficit going from 3 to 6.3%, there is definitely, and this is a theme that we're looking at, where does debt go with cost of debt increasing rapidly? And it's really interesting to see that companies so far are less exposed than governments, because a lot of companies have actually fixed rates during the low rate environment. So I think, the markets clearly have to pay attention, but we have to remember it's still investment grade. It's reflecting the past.
Yeah, but do you think the equity markets would move beyond this story very quickly? Because the benchmark over here, the comparison over here is the downgrade from S&P that came by in August of 2011. 12 months after the downgrade, actually the market returned, the S&P 500 returned 15%. And so do you think that, in a couple of days, the dust would settle on this issue and investors would move on?
Yeah, I think from that perspective, yes. But there are other potential trigger for consolidation. We have to remember we've had very strong markets. We have the macro peaks. So we have inflation peak, we have growth slowing down, but we still have core inflation. If you look at Europe, if you look at Bank of England, core inflation is what central banks are looking at. And core inflation in Europe is not coming down as expected. Plus, you have food inflation that probably could go up if you see wheat prices, etc. And if you look at the oil price on average for June last year, we were $115 versus this year about $75. Where does the oil price go if China manages to support its growth? So I think we have potential triggers for consolidation that are not only related to this event. You see what I mean? And then the markets would revert to...
focus more on the macros.
Yes, exactly.
It's funny because Tanvir and I off air yesterday were talking about El Nino as well, and the fact that people aren't really factoring that in to inflation and commodities inflation in the second half of the year. I just want to turn back to something market specific. Again, we're midway through the earnings season for the U.S. and also in Europe as well. And Tanvir and I were discussing that even though there have been a good number of beats, this is obviously coming off a much lower base. And actually year-on-year earnings are showing quite a deep decline, 7% or so. Revenues also dropping a little bit. Earnings expectations for the third and fourth quarter have started to get revised down. Is the market out of whack with everything that is coming through on the ground?
So I think there's two things. One, if you look at the beats, the companies who have beaten are actually quite large as a number, but expectations were quite low coming into the earnings season. That's one thing. The second thing is the looking forward. What do we see? And this is why we're doing a lot of work on what we call pressure points. So you have the debt side. Actually, debt is now at a much higher level. People have taken on a lot of debt, but 75% of the non-financial corporate debt is fixed. So the impact, we don't have a wall of refinancing coming. Pricing power, what do we see pricing power? So you have the asymmetrical impact of inflation. Remember, when you have disinflation coming, it's the reverse in terms of top line in particular.
And margins.
Exactly. Has all of this been embedded in the current guidance? I think it has not. But again, if you bet on, and this is why I think you still want to bet on quality in terms of style, quality growth, quality value, very targeted theme, and you want to have pricing power. That's very important. You can still find it, but you have to be very careful. It's a stock picker's market.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.